This is Optimal Finance Daily, episode 2104. Fire Tax Strategies for Beginners, Part 2, by Sean Mullaney of FiTaxGuy.com. And I'm your host and personal finance enthusiast, Diana Merriam. Today's post is a continuation from yesterday, so if you're new here, I'd recommend listening to yesterday's episode first. But if you're all caught up, let's hear Part 2 and continue optimizing your life. Fire Tax Strategies for Beginners, Part 2, by Sean Mullaney of FiTaxGuy.com. 2. Establish a Roth IRA. For a primer on Roth IRAs, please read my Ode to the Roth IRA when you can. Roth IRAs, like traditional IRAs, are individual. You establish one with a financial institution separate from your employer. Generally speaking, a Roth IRA gives you tax-free growth, and if done correctly, money withdrawn from a Roth IRA is both tax and penalty-free. There's no better account to hold in retirement than a Roth IRA. Why not start one today when A, federal income tax rates are at historic lows, and B, Roth IRA contributions give you an immediate emergency preparedness benefit? Roth IRA contributions can be withdrawn tax and penalty-free at any time for any reason. The Roth IRA is the only retirement account that offers unfettered, tax-free access to prior contributions. Note, however, in most cases, the best Roth IRA strategy is to keep money in the Roth IRA for as long as possible, so it continues to grow tax-free. Every working and retired American should ask themselves whether they have a Roth IRA. If they don't have one, they should ask why that is. For those who do not currently have a Roth IRA, now is as good a time as any to consider a Roth IRA contribution, if you qualify, a backdoor Roth IRA, or a Roth conversion. 3. Contribute to an HSA to the maximum allowed if you're offered a high-deductible health plan and the high-deductible health plan works for you. A health savings account is a very powerful savings vehicle. You have access to it if you have a high-deductible health plan. To have a high-deductible health plan through your employer, you need to determine 1, if your employer offers a high-deductible health plan, and 2, whether the high-deductible health plan is appropriate medical insurance for you. If you don't have employer-provided insurance, you may be able to obtain a high-deductible health plan in the individual marketplace. Let's assume your employer offers a high-deductible health plan and you determine it's appropriate for you. At that point, you need to prioritize contributing the maximum to the HSA, second only to receiving the employer match in your 401k or other retirement plan, and establishing a Roth IRA. You receive an upfront income tax deduction for the money you contribute. If the funds in your HSA are used to pay qualified medical expenses or are used to reimburse you for qualified medical expenses, the contributions and the earnings or growth are tax-free when paid out of the HSA. This tax-friendly combination means the HSA should be a high priority. Here are a few additional considerations. Payroll taxes. The HSA has an additional benefit. Contributions made by an employee through payroll deductions are federal payroll tax deductible, unlike contributions to employer retirement plans. To get this additional benefit, you must contribute through an employer payroll deduction. Writing a check to your HSA only creates an income tax deduction. State income taxes. In California and New Jersey, HSAs are treated as taxable accounts. Thus, in these states, there are no state income tax deductions for contributions to an HSA. Furthermore, dividends, interest, and other realized income and gains generated by HSA assets are subject to state income taxes. While detrimental, the federal income tax and payroll benefits are so powerful that even residents of these states should highly prioritize HSA contributions. Employer contributions. Check to see if your employer offers an employer contribution to your HSA. Many do. When the employer does, the employee leaves free money on the table if they don't enroll in the high deductible health plan. Reimbursements. In most cases, it's advisable to pay current medical costs out of your own pocket, your checking account, and other taxable accounts, and record and track these medical expenses. Leaving money in the HSA allows it to grow tax-free. Years later, when the money has grown, you can reimburse yourself tax-free from your HSA for the previously incurred costs, as there's no time limit on reimbursements. In most cases, there should be sufficient previous medical expenses that can be reimbursed tax-free from the HSA. Note that only qualified medical expenses incurred after you're first covered by the high-deductible health plan are eligible for tax-free reimbursement. And 4, save, save, save. My last recommendation is simple: save, save, save. Are there ways to do it in a tax-efficient manner? Absolutely. But the absolute most important consideration is the act of saving and investing itself. Between retirement plans, lack of a payroll tax, and favored dividend and capital gain tax rates, saving and investing are often tax efficient without trying to be. Conclusion. Here are the top 4 tax moves I believe FI beginners should consider. First, contribute enough to your 401k or employer plan to get the full match. Second, establish a Roth IRA. Third, max out an HSA. And fourth, save, save, save. Of course, this post is not tailored for any particular taxpayer. Please consult with your own tax advisor regarding your own tax matters. You just listened to part 2 of the post titled Fire Tax Strategies for Beginners by Sean Mullaney of FITaxGuy.com. When I was working a W-2 job, I followed the advice Sean presents here and prioritized my tax-advantaged accounts while my income was high. This article reminded me of an Instagram post I saw the other day from an influencer named Money with Katie. She said, quote, "Wealth building is so cool to me because it's the only thing in life where you can front load all the effort and then reap the rewards indefinitely. It'd be like if having 6-pack abs by 30 meant you'd be guaranteed to have 8-pack abs by 55 with no additional effort," end quote. This to me demonstrates the long game, but in a way that doesn't make the short-term sacrifice feel like such a hard choice. When I think about how I fully funded my retirement vehicles for 4 or 5 years and reached Coast-Fi status, this feels like such an easier thing to do than spend the rest of my working years saving for retirement. I front-loaded the effort at a time when my income was high and it was much easier to save. Now that my income is much lower, it's more tolerable because my need to save is also much lower. So that financial decision has benefited me for the long term and right now. When it comes to the long game, none of us knows what the future holds. We could be totally rolling in the dough or face a hardship that makes generating an income difficult. That being said, I think the best thing I've done for the long term is learning how to be happy living pretty minimally. By having very low fixed costs and knowing how to entertain myself without spending a lot of money, I feel confident that I can handle whatever life throws at me. And with that, have a great rest of your day, and I'll catch you tomorrow with another post where your optimal life awaits.